Well, sorry, a couple of minutes later than as per usual. My name's Alec Hogg, and it's a real pleasure to be with you today. And we have South Africa's top performing 12J fund, Jonty, Gaurav, Nair, are going to be taking us through the presentation. But guys, you say, I know in your marketing material, and we are partners, business partners in this, you say you're the top performing 12J. Jonty, how does that come about? Do you take all the 12J funds in South Africa and then rank them against each other?
So yeah, Alec, what's surprising, given that this is an investment, is that many Section 12Js don't actively or openly report their returns. So what we did as a business is we had to scrounge around and dig and find returns of competing funds. So we got a significant portion of the market's returns, and we really looked at the larger funds, and we did a comparison. And Infinity Anchor Fund since 2018 has done exceptionally well, outperforming our largest competitors year on year. Not only in terms of growth, but also in terms of dividend distribution. We did a recent comparison to our largest competitor, where in the same vintage, they were paying out a dividend of 1%, where the fund managed by Gaurav paid out a dividend of 5%. And it's consistent. Every year the fund has performed exactly how we've anticipated, and it's largely around the investment strategy. And I think we'll hear from Gaurav a bit later how this investment strategy, from our perspective, is one of the lowest risk strategies in the market, and it should continue to yield not insane returns. We're not promising 20, 30, or 40, 50%. We're saying we'll give our investors with a tax benefit around 15 to 17% per annum, and we've been achieving that 3 years in a row now. So this fund has done exceptionally well, and we haven't found or seen a Section 12J investment in the market that's done better. And I challenge anyone to find one. Please send me the details. I don't think you will.
Okay, so that's the one part of it. It's low risk. You're already getting the benefit from the receiver of revenue, or SARS, who allow you to write back the full investment in a 12J fund against your taxable income. So your top bracket, that's a 45% injection, really, Jonty.
Yeah, so the tax benefit goes without saying. It's very, very attractive for an investor. If you just get your money back at a 45% tax bracket, you're looking around 8% annual return, which is incredible. But that's offered by all 12Js equally. What you're really looking for is a fund manager who's incentivized to produce additional yield. And depending on the type of investor that you are, maybe you want a 50% return, possibly unlikely in this market, or you want a low risk, moderate return, and someone with a track record. And if that is the case, I think we're the only fund in the market.
Before we continue a little bit further, I just want to be absolutely sure that everybody can hear us, and just to go through a bit of the technicals. If you look at your control panel, you'll see that there's a hand. That's meant for a high five, or to stick up your hand. Please, would you do so now if you can hear me okay? So in other words, there we go. The hands are being raised. Thank you very much indeed. And then the second thing is that have a look at your control panel, and you'll see a big question mark. And on that question mark is where you, if you click on that, it opens up a little box where you can put in the questions that you'd like to ask to Gaurav and to Jonty over the next 45 minutes or to an hour or so. So that's the way it all works. I'm glad everybody can hear us. Gaurav has got a presentation he's going to take us through. But before we do that, the last point, Jonty, that by introduction, is that we know that 12J ends on the 30th of June. So that's it. It's all over. If you don't get your money in by the 30th of June, it's over. But from your perspective, and what makes you fairly unique in this market, is that you're prepared, or you're able to take investments of 100,000 Rand upwards. Now, how does that work, given that so many of the 12J companies need investments of R1 million upwards?
Yeah, it boils down to scale. So as a business, we're not only in 12J, there are other parts of our business, and we've got a huge staff complement, and we're able to process large volumes of investors. If I give you an example, believe it or not, we raised 90% of our money in the last 3 days. Now, if we're talking February, this past February, from the 25th to the 28th, I think we processed for over 400 investors. So we can handle large volumes. So for us, 100,000 Rand investment versus $1 million, it didn't really make a difference. We can process the investments quite quickly. We have an online application form. It's smooth, it's quick, it's easy. And that's not a problem. For other 12Js in the market, the fund is probably potentially their only focus. So they don't want to go and hire an enormous amount of support staff. They would rather have a smaller team and really scale down and keep the overheads as low as possible. And for them, R1 million makes sense because for that reason. But also from the Companies Act perspective, to be able to receive R1 million, less than R1 million investment, there's an additional layers of compliance that you need to comply with. And for a lot of 12Js, they don't, that hassle, having for example, an audit committee, it's too burdensome, and they'd rather just, stick to their knitting and offer it as a R1 million investment. Where for us, we've got the scale. There's a lot going on in our business from an investment perspective, so we can handle probably 1,000 investors a day.
Thanks for clarifying that, Jonty. Gaurav, how did you and Jonty meet, or how did you guys get together in your relationship? Before you get into the presentation, tell us a bit about that.
Yeah, so fortunately, I've known Jonty since high school, actually. We didn't go to the same high school, but we've been friends for a number of years. However, we diverged in university. I studied actuarial science and ended up qualifying as an actuary, and Jonty went on to become an attorney at ENS. But as we were going along, Jonty found that he wasn't enjoying law as much as when he looked over the fence and saw myself and my business partner, Derek, being entrepreneurs. And he really wanted to join and look at more of the business side rather than just the legals. And so, we could see the benefit of having Jonty. He's got a great eye for opportunities. He can read the market well, etc. We too felt he was being wasted as a lawyer. And so he joined us and joined us as a partner. And really, we haven't looked back since. We've been enjoying Jonty, and he's helped us grow this business. A great deal of the growth has been due to him. So very happy to have had him with us these last, I think it's been about 6 years now. Hey, Jonty.
And this is the 7th year.
7th year. Yeah, so we've enjoyed it greatly.
But it's unusual for actuaries to become entrepreneurs. Often lawyers and accountants, people who get their CAs or their LLBs, that you can kind of, it's almost acceptable that it happens as a route into entrepreneurship. But for an actuary to become an entrepreneur, after you spend all those years doing all the hard work, what took you there?
Yeah, I mean, in some ways, it can be a strange decision. I mean, when I told my mom that I was leaving working, I was working at a large insurer. When I told her I was leaving for entrepreneurship, she was very surprised and asked me the same question: Why did you study so hard and write those board exams and qualify? But in some ways, it's actually almost a no-brainer choice. And the reason I say that is that as an actuary, you're imminently hireable. And even if you fail out there in entrepreneurship, as a large number of businesses do, you can get a job very easily. There's a shortage of qualified actuaries. And so at the time, being in my early 20s, that was more than 10 years ago now, and having this safety net of the actuarial qualification, it seemed like, with no obligations, no family at the time, no wife and kids, it seemed like not that big a risk to take, to go out and try. And if I failed, I knew that I'd be able to get a job quite easily. So that's how I made that decision.
It's interesting. As you were talking, I was thinking, who else do I know who's an actuary who's become an entrepreneur? Of course, Magda Wiziccha, she's an actuary. And then I thought a bit more, Skalk Malan at BrightRock as an actuary became an entrepreneur. So it's not really that rare, but I'm sure it does give you an advantage. Anyway, enough jibber-jabbering from my side. Gaurav, do you want to start off? I see we've already got a couple of questions, but I'll stop you as we go through, switch off my camera now, so we just have the two good-looking guys on the screen, and perhaps you can take us through this, and we'll pick up the questions, I'll interrupt you from time to time, and let's just get cracking, shall we?
Sure, let's do it. So to start off with, to speak about just Infinity Anchor Fund in general. So Infinity Anchor Fund, we invest equity into businesses, and these businesses, they have a lot of assets on their balance sheet, and they have to have some kind of regular contractual cash flows. Typically, this can be an asset rental business where there's a bunch of assets that are being rented out, and that ticks both those boxes. But there are other types of businesses that also meet this criteria. So one of our investments that has performed well is a business that invests in fiber networks, and the contractual cash flows comes from people accessing the internet or buying data. And another example would be, for example, a solar PV company, where the assets would be the actual solar panels, and then of course there are power purchase agreements, which then are the contractual cash flows. And this is why we see ourselves as a moderate risk business, because the businesses we invest into have a nice set of assets on their balance sheet, and then regular earnings going off into the future. We have a focus in Infinity on risk mitigation, and that'll be a bit of a theme today. And what we do is, whenever we invest into a business, we usually invest into a brand new business. We start a brand new business, and this company, we end up co-investing with a management team. So this management team, they usually have as an existing company that's been already doing this in the sector, and we make them co-invest with us. So that one bubble that says first loss, they co-invest some capital with us into this new company, and we structure it such that their investment is the first investment to be eroded in a negative event. So if for some reason things are going wrong and the investment has actually shrunk in size, then their investment is eroded, and that protects the Infinity investors. And this kind of aligns interests between us and the management team that is actually making the decisions on a day-to-day basis and controlling the investment. But the other thing go for it, Alec.
Yeah, I'm just thinking. We are going to get through the presentation, but it'd be lovely to chip in from here and there with questions. And Nilesh asks one, and just by the way, when you pose your question, don't worry about your surname coming up on screen. I will only refer to you by your first name, so there would be no loss of your anonymity. Nilesh says, how much of your work is 12J, and what is the impact of 12J closing on your team and your ability to see investors through to 5 years and beyond? That's a good question, and it maybe picks up a little on what you were saying in the beginning, Jonty.
Yeah, so we're very fortunate. We're the second largest Section 12J fund manager in the market. We manage over 1.3 billion rand. So we're very sustainable. For the next 5 years, we've got an income from the funds that we manage. But I think most importantly for our investors, we're highly incentivized around a performance fee. And that performance fee is only on the growth of your investment. So if you give us 100 Rand, if it grows to 120 Rand, we only incentivize around on the 20 Rand growth, which we only access at the end of the investment. So we only access that when we exit our investors, which is a really important risk consideration for an investor. And that's only at the end of the 5-year term. So we're very much incentivized to hang around. But to answer the question, so as a business, we have two focuses. One is fund administration. So we administer Section 12J funds, other alternative funds, property funds. That's why we've got such a large staff complement. And on the other side, we're alternative fund managers. So Section 12Js is something in our business that's been very successful. There are other alternative investments. For example, I'm sure we'll have a webinar on this with Alec in a couple of weeks to come, but in the cryptocurrency environment, we develop new innovative cryptocurrency investments, which we think are lower risk than your vanilla investments. But that's what we do as a business. We're an alternative investment fund manager. I hope that answers the question.
You did, and indeed, you actually picked up on Nilesh's follow-up question. So all good. All right, Gaurav, let's get back to the presentation.
Fantastic. So onto the second bubble, or it's the first bubble here. It's called the guaranteed yield bubble. So this is another way in which we manage risk. When we make an investment, we look at a business that already has a track record, and we due diligence that business. So it's a healthy business in its own right, but that's not the business we invest into. We start a brand new company, and the reason for this is we want to make sure that there's no hidden liabilities, etc. And this brand new company then carries on that same business, but it's the company that our investors, along with the first loss investment, that is exposed to. So we're not exposed to the historical liabilities, etc. But what this allows us to do is it allows us to structure in as a risk mitigation that original healthy business we due diligenced, that it can guarantee our investment a certain return. And this is another way in which we mitigate risks for our investors.
Next slide.
Yeah, please. Thanks.
Okay.
So over here, it's just to talk about some of our performance results. So to look at our investors that came in 2019, and the returns are very similar to each other in every year. Well, we've got a track record of having paid about 5.1% per annum as a dividend yield to investors, and we've been paying this consistently every 6 months, so semi-annually. A lot of the other funds out there, they measure their returns, including the tax benefit. So in order for comparison purposes, that 5.1% becomes 9.27% when you actually include the tax benefit as well. We've been earning a return of about 15.35%, including the tax benefit for investors. And we've had 100% of our capital invested. And this just speaks to the fact that when funds take a long time to invest capital, then the money sitting in cash is just earning interest, and this harms returns. At Infinity, we focus on deploying funds quickly, but without sacrificing on the due diligence. So there's a prioritization of speed of deployment, and this allows us to generate these healthy returns. Next slide, please, Alec. So this is a business that we have previously invested into and has now asked us for more capital. And it's what I call a follow-on investment. So the investors coming in this year in June are in quite a nice position because we have a portfolio of existing investments, and some of these investments have done well, and now they need more capital. And to be crystal clear, these aren't businesses that are now distressed, or they have grown, and now they need more capital to buy more assets to service extra demand and rent these out or earn other contractual cash flows from these assets. And the reason that we like follow-on investments is that even though we do a comprehensive due diligence on new investments, when it comes to a follow-on investment, we already know the management team, they've proven the business model, we've gotten to enjoy working with them, we understand all the nuances of the business more and more, and so it's a lower risk investment. And what we do is every time we make an investment, we have a right of first refusal on all follow-on investments. So the investors coming in June this year, they're in a position where we estimate about 40 to 60% of where we'll invest their money is into follow-on investments, which are of course lower risk for the same level of return. To talk a bit about Rise, they're looking for an additional 20 million rand. We've already invested 20 million rand with them, and their business model is that they own, develop, and operate fiber infrastructure to provide high-speed internet access to residents. So as you can imagine, during lockdown, we all find ourselves working from home, having meetings like this over video. Even aside from that, consuming a lot more media via Netflix and so on, as we couldn't go out at night or whatever else. And so demand for high-speed internet went through the roof. And the interesting thing we noticed is that even as lockdowns ended and people started going out more, in theory, people didn't cancel their internet contracts. And so in fact, we realized that once you get a taste of high-speed internet, you're very reluctant to go back to kind of lower speed internet, and you end up actually being a very sticky customer. So Rise has, of course, seen their business grow aggressively, and now they need more capital to lay out more fiber networks. on contracts that they've already won. The expected level of return for the Infinity Fund, so this is excluding any tax benefit the investor gets, this is just the return to the fund, is somewhere between 10 to 15% per annum. And most of this, and this investment is of course exclusive to us. If we can go to the next slide, please. Yeah.
Just before we go there, Fikri asks, regarding the indicative 7.4% annual dividend, is this before or after dividends tax?
So this is before dividends tax. So if you're a company, of course, you don't have any dividends withholding tax. If you're an individual, then we have to withhold 20% to pay directly to SARS.
Okay, so it would be after that, the 5.1% that you, that is after dividend tax, is that correct?
No, so that's before dividends tax. That's before dividends tax.
So you'd get about 4% roughly after dividends tax.
That's right.
Nilesh has come back with another question. What is the IRR without the tax benefit?
So the one way to look at it, as Jonty gave a bit of a heuristic, a bit of a guideline, is that the 45% tax benefit attributes roughly 8% per annum. So you can say it's between that the return without the tax benefit is between 7 and 8%, but that is a return after all fees and taxes. So it's not that is the return you actually get in your hand, and that return includes deducting the dividend withholding tax if you're an individual.
Johan asks, the returns for 2020, were they in line with 2019 figures?
So with 2020, they are similar with respect to the projected return. It's coming in at about 15 point something percent, between 15 and 16%. The dividend yield was a little bit lower. The reason being that with 2020, as we raised the money in February of 2020, in March we immediately went into lockdown. And even though we had a pipeline of businesses that we were ready to invest into, as the board of the company, we decided that we wanted to hold off on investing because we wanted to see how the pipeline of businesses performed in the coming months. So we decided that for 6 months we were not going to invest. We were going to take the prudent approach and see businesses that we had planned on investing into, how did they perform during lockdown. And this was quite a key step because some of these businesses did not perform well during lockdown, but fortunately we had not invested into them. And so we actually then reprioritized our pipeline based on the businesses that were robust or quite immune to COVID and lockdowns, etc. And so that 6-month waiting period resulted in a slightly lower dividend being paid for the 2020 investors.
Arthur's got a few questions. Jonty?
Sorry, Alec, if I wouldn't mind asking Gaurav a question just to give, I think it was Johan, some peace of mind around our 2020 investors. So Gaurav, although investment was slower, and arguably it is because of COVID, we obviously wanted to take our time before we invested investors' money. When the money was invested, or it has been invested, how have those investments done if you compare those investments to our 2019 investments? In other words, once money has been deployed, is performance the same, better, or worse?
In fact, the performance is actually marginally better. And sometimes this is a bit counterintuitive, given that we invested into businesses during the kind of the COVID environment. And quite interestingly, it's quite a counterintuitive result, but there's an explanation for it, which is that what we saw in our pipeline of businesses that we started investing into is that the quality of business in the pipeline actually improved. And the reason that happened is that some businesses that were previously not part of our pipeline and previously getting debt funding from banks, etc., even though they had performed well, they had not defaulted on any payments to the banks. They'd been paying on time, etc., etc., and they had grown. So they did not need more capital because they were distressed. They had grown. They needed more capital now. The banks had declined to extend new facilities to them, and we could understand that this must be because the banks had probably felt, from a risk point of view, they want to limit their risk exposure, and so they probably decide they want to not extend new facilities. So we saw these businesses that are really healthy, low risk, that we normally would not get access to, coming to us and asking us for funding and accepting our more expensive capital than debt funding. And so we actually saw the quality of our pipeline improving. And so, excuse me, we now find ourselves in a position where the 2020 investment is actually performing marginally better than the previous investments. Excuse me.
Thanks for that clarity. Yeah, have a little sip of water. Arthur's question, he starts off with, how long is this investment? He's got a few, so let's just answer that one first.
So when you invest for the Section 12J incentive, as an investor, you need to be in for 5 years. Any shorter, if you sell your investment before that, then the tax benefit you get is recovered by SARS. There aren't any penalties or interest, but it's recovered. So what we aim to do at the fund is, knowing this, we aim to keep you invested for 5 years. After 5 years, we start planning for it in year 4, but we liquidate the investments so that after 5 years, we then are able to exit you from the fund, and then the tax benefit you get is permanent.
What is the tax saving if my tax rate is 42%?
So if your tax rate is 42%, and let's say you happen to be a PAYE payer, so it's been deducted from your salary on an ongoing basis, at that point, at the point that you make the investment, if you invest, let's say, R1 million, then next year when you submit your tax returns to SARS, you will submit your share certificate from Infinity to SARS as well, along with that. And then what they will do is they will then refund you because you've paid tax during the year, and in essence, you've overpaid. You've paid based on your total income, which has been reduced for the investment you've made. So SARS should then refund you 420,000 Rand, 42% of the R1 million investment.
Are the funds safe?
So primarily, we're investing into businesses, and with our focus on risk mitigation, we're doing everything we can to make sure that they are safe as possible. So by its very nature, our investment mandate is we're investing into businesses that have lots of assets on their balance sheet, and they have contractual cash flows. And those businesses, we also make sure that their processes are up to scratch, so that when they do a credit check on their final client, because they're renting out, let's say, dental equipment to them, that what is their credit checking process? What is their collection process? And if a client does default, what is their recovery process? Going in there, collecting the equipment, and then redeploying it, finding a new client to rent it out. So for an investor, there are multiple layers of security. Firstly, this is the fact that we have legal recourse to final clients. They should pay on an ongoing basis. Secondly, we have an asset underpin that we can go in and take and redeploy or sell. Thirdly, we have some kind of extra risk mitigation, as we covered. We either have a first loss that the management team co-invests with us, or they provide us a guarantee, or both. And by its very nature, we're investing into businesses that aren't like tech businesses, for example. If you're trying to find the next Facebook, it could go 1,000 times, or it could go to zero. So by its very nature, you're not going to make 30, 40, 50% per annum in these investments. But on the other hand, they have all these layers of security.
And then the final question from Arthur. Sorry, Jonty.
Alex, sorry, I myself popping in and out. Apologies. I think just something to add to Gaurav's last comment is diversification. So we're not investing into one business. We're investing into every year between 6 to 12 businesses. So there's a lot of diversification in the fund. But importantly, even within those businesses, they typically don't have one client. They've got 50 to 100 clients. So what you really have to see is a huge amount of default within one business across all their clients, and then default in other businesses, or poor performance in other businesses, for us to really start seeing losses within our investment. So the diversification of this fund is exceptional, and that will then obviously allow investors to have some comfort that their money is protected. Obviously, is it safe? Well, it's an investment. Investments have risk, but we feel that the risk mitigators that we have in place has reduced the risks significantly to investors. And I think, just as a last comment, myself, Gaurav, my other partner, our staff, friends, family, we heavily invested as investors into this fund. Every year, we determine how much we need to invest as an investor to reduce our tax, because as everyone, we don't like paying tax, and we invest. So we incentivize not only as a fund manager, but as an investor to make sure that our capital is first and foremost protected and that we see a nice return. And for the last 3 years in a row, we've achieved that.
The final question that Arthur asks is, what interest rate can you expect?
So we're paying dividends as the form of income, so it isn't interest because you're getting shares in the Section 12J investment, and then we hope to also provide you some growth in your capital. So the dividend income is roughly that 5.1%, which ignores the withholding tax per annum, and then we're also expecting about a 20% capital growth over the period. So overall, your return, which combines the capital growth and the dividend income you're receiving, that comes to about between the 15 to 16%, which includes the tax benefit.
Terry asks a question, which he says he has asked previously in a webinar, but wants a bit more detailed answer. He says, if you financially emigrate, will there be any complications should you exit only after 5 years?
So if you financially immigrate and if it happens during the 5-year period, I don't know if you can. So the way that I understand financial immigration to work is that all of your assets are seen to have been disposed and then reacquired. So if this happens during the 5-year period, there is the financial complication, but that's not what the question was. The question was, what happens if it happens after the 5-year period? So during the 5-year period, then you might face this tax recoupment. After the 5-year period, the only effect, which happens to everyone, not just the person financially immigrating, is that you have to pay capital gains tax on the exit of your investment. Now, the capital gains tax for these Section 12J investments is a bit different because you have to pay capital gains tax not just on the gain, but on the full amount. And the reason being that when you get a tax deduction, then you have to actually pay CGT on the whole amount. As an individual, this still makes sense to you. One might be asking themselves now, well, does this make sense? It still makes sense because coming in up front, you're potentially getting a 45% deduction. And then on exit 5 years later, so you're also getting the time value of money, the benefit of this being later. 5 years later, you're only paying 18% as capital gains tax. So that's the only thing that should happen to you when you exit in 5 years.
Vickery's question is, on a 1 million rand investment, what is the capital that you get back at the end of 5 years, and what portion gets the performance fee deducted? How much is the performance fee?
Great question. And the reason it's a great question is that kind of in the Section 12J landscape, there are a number of fund managers and they charge fees that includes the tax benefit you get just by virtue of this being a Section 12J investment. And that's called a performance fee on net capital. And that, of course, means that there's a high performance fee, which then harms returns for investors. With Infinity Fund, that's not how we charge performance fees. We charge performance fees only on the growth in the total capital that has been given to us. There's no performance fee on the tax benefit you're getting. The performance fee is only charged on exiting you from the investment. We expect to pay about 1.2 million rand on exit. So the performance fee is 20% of the growth above. So this is 1.2 million rand per every million rand, I should have said. So the performance fee is 20% of everything above the 1 million rand provided. So it'll be 20% on the 200,000, and of course then CGT applies as well.
Okay, well, I'm sure there will be a lot more questions coming through, but let's continue with our presentation.
Perfect. So again, just to give investors the sense of the kind of businesses we invest into, this is a business that's in our pipeline, and what they do is they rent out dental equipment to dentists. Now, why we like this is that, one is that dentists, the service of dentistry is actually a grudge purchase. 80% of their revenue comes from the fact that people have toothaches and they can't sleep and they have to go to a dentist. And we saw this even during lockdown. It's that the dentists, their revenue only dropped during the hard lockdown when no one was allowed to go to work. Thereafter, their revenue was almost the same as pre-COVID. And so people, they have to go to the dentist when they have a toothache, and that's the majority of their business. Now, when you rent out the dental equipment, you're in the position that if you go to the dentist and take the dental equipment away, they can't earn a living. So it's key to their practice, and hence they are very reluctant to default on payments. And their revenue stream is very robust because people have to go to the dentist. So it's very credit-worthy clients because they have such a robust revenue stream, and it's something that they won't default on. The business we're looking at investing into, they've asked for about 20 million rand. The expected return that we can earn from renting out this dental equipment is between 10 to 15%, again, ignoring any tax benefit. And again, they've signed exclusivity with us, so we're the only 12J fund that can give them this funding. We can go to the next slide. Another business in our pipeline is a business that does the installation of solar panels and then the sale of electricity. Their focus is on corporate and industrial. So they don't face any residential individuals, for example, and they don't face any of the public sectors, municipalities or anything like that. It's purely, for example, supermarket chains or distribution centers or factories, etc., that are their client base. They've been in the space since about 2009, which in South Africa was about when the solar industry really started getting going and became commercially viable. So they're very experienced in South Africa. They're looking for investment about 50 million rand, and this is actually for a specific tender that they've won. They won a tender to install solar panels on the roofs of a very well-known supermarket chain in the country. And so they're going to be installing these across numerous of these supermarkets and then selling the electricity directly to that supermarket chain. So blue chip client. The expected returns are about between 15 to 25%. The reason the returns are so high is that the energy prices escalate over time. They escalate slower than what the supermarket chain is expecting to pay Eskom. So it's still a good deal for the supermarket chain, but it results in good returns for the solar provider and us as the co-investors. And once again, this investment opportunity is exclusive for Infinity Anchor Fund. We can go to the next slide, please. So at Infinity, one of our key focuses in terms of our strategy is to focus on deploying the money quickly. And in order to do this, what we do is we go out and find the investment pipeline before we raise funding. Of course, there's a risk in that you have to go out and do work and start vetting businesses, etc., before you have the money. So if you then don't raise enough money, the work might be seen as wasted. And so a lot of funds take the opposite approach. They first raise the money and then they go out and look for places to invest it. But what this does is that it puts investors in a position where their money is then just sitting, earning interest for a long period of time while they go out and then find the investment pipeline. And then as they raise more money every year, the queue of money gets longer and longer. Investors find themselves waiting longer and longer. So we don't do that. We go out and find the investment opportunities first. And I wanted to give you a sense of the type of businesses in our pipeline now. So in total, there are 24 businesses in our pipeline, and it comprises a total investment opportunity of about 375 million rand. If you look at it, it's across a variety of sectors. I've summarized the other 19 companies in one line because the 24 would be too big to fit on the slide, but it's across a number of sectors. So we've obviously touched on the medical equipment and the solar. We also have a business that's in office automation. So this is equipment for offices such as PABX systems, etc. We're not talking about the old-fashioned PABX systems. We're talking about PABX in the cloud. Internet infrastructure. So this is the follow-on investment that we mentioned earlier into Rise. Drilling equipment, so industrial use, again, blue chip clients that require drilling equipment. And what you'll see is that the return that we expect to get from this pipeline of investments varies between 10 to 25%, and that's excluding the tax benefit that investors enjoy on top of that. And also what we do is when we start negotiating with these businesses upfront, we make them aware of our investment terms. And if they agree to our typical investment terms, we then sign a term sheet. And this term sheet, usually we manage to negotiate exclusivity. meaning that we are the only 12J fund that can invest into these businesses for a period of time. This ensures that they don't shop around our terms to anyone else and then get an investment. But for our investors, they benefit in that they know that these investments are exclusive to them. And as you can see across the entire pipeline, this amounts to about 75% of our pipeline is exclusive to Infinity Anchor Fund. We can go to the next slide, please. Now, this slide here, it illustrates a special offering we have for June of this year. Given that Section 12J is ending on the 30th of June, a lot of investors find themselves in the position that they don't necessarily, having just invested in February, for example, they don't necessarily have the cash flow to make an investment right away compared to the size of what they expect their taxable income for the year to be, with bonuses and so on coming later in the year. So what we've done is we've got a solution where we've partnered with a financial institution to provide funding for investors to come in. And how the funding works is that investors have to only invest 5% before June, and 95% will be the funding provided by the financial institution. So to take an example of a R1 million investment, investors have to put down 50,000 Rand, and then the remaining 950,000 is invested by the financial institution. And between now and the 1st of October, there's a very preferential interest rate, which is 4% per annum, a fixed interest rate of 4% per annum. Why the 1st of October 2022 is because at that point, we expect investors to get their first, the tax rebate from SARS. And at that point, they then take that tax rebate and use it to repay a portion of the loan. So at that point, they should have about half the loan repaid if they've got a 45% tax rebate of about 450,000 Rand. And then thereafter, they repay the loan over the next 2.5 years in 3 payments annually. The interest rate goes up from 4% to about 7%, 9% fixed, so prime plus 2, but it's fixed, and then thereafter it moves to prime plus 2. So because we work closely with the financial institution, we should be able to approve funding within 24 hours if you meet the various credit criteria. And the only security that we take are the actual shares in Infinity, and the dividend payments are also used towards repaying the loan balance. But I'd like to stress that even though one is only putting down a 50,000 Rand deposit in this example, you still get a tax deduction of the full R1 million in this example. When it comes to the funding, the minimum investment size is 500,000, so that relates to a deposit of 25,000 and then funding of 475,000 Rand.
Just to understand that a little bit better, if
Yeah.
I have taxable income of R500,000, just for argument's sake, and I put in 50,000 Rand to borrow R1 million. So in the first year, I write back the 500,000 Rand against my tax. Can I take the other 500,000 and write that back in the next year, or is that lost?
I'd actually have to defer to Jonty here because I know he's fielded this question and actually got some advice on it. So let me defer to him here.
Yeah, so Alec, the answer you're looking for is whether the tax benefit can result in an assessed loss. In other words, can you carry over the loss that you've created? So
exactly.
We've got an advice from a tax practitioner. The tax practitioner is the test case. So the advice is that it can carry over. I've never personally done it. In the past, we would just advise investors to invest on the 28th of February and then on the 1st of March, so you have it in 2 different tax years. So the advice that we've received is that it can carry over. The tax practitioner in his personal capacity has been in assessed loss for many years. So that's the view. That's the view that we've seen, and we obviously have a legal opinion on that. So if there is someone who wants to invest in, which will result in them creating an assessed loss, I can, very happy to pass on that legal opinion to them.
Thanks, Jonty, because in one of the other webinars that I was involved with, we actually spoke with a tax expert, Albertus Murray, and he gave that chapter and verse, and he said it really makes sense because this is the last year to go aggressively this year and get the biggest possible benefit that you can, because in future years you'll be able to write back that assessed loss. I can understand why in the past it didn't make sense. Well, because next year you were going to invest in another 12J and another, and so on. So you could just put in what you needed for your liability. But it's quite an important aspect when one considers going into the into the future, and that 12J is ending.
Yeah, no, agreed. And it's a question that comes up often. You know, if we look at the funding solution that Gaurav mentioned now, it's gained a lot of attention, a lot of attraction. We've got over 70 million rand already invested, or applications for over 70 million rand, and about 75% of our investors are taking up funding, and they're taking it up in two forms. Either they're saying, I don't really need funding, but I need to make a R1 million investment. Let me put down 550,000. I'll get a loan of 450,000, and when I receive my refund in October next year, I'll use the refund to pay off the loan. So basically, I'll use someone else's capital at a low interest rate of 4% from now until October. Or the investors are saying, you know, I'm pretty happy with gearing. I'll take someone else's funding. The security is only the shares and dividend payments. So let me put on 5%. I'll fund 95% at 4% until October next year, and then I'll make a decision whether I want to pay off all the loan or some of it. So the funding from our perspective has been a real eye-opener for our business, because it's a great solution for investors who, you know, currently just don't have the cash, which is fair. You know, no one anticipated having to make a tax deductible investment in June.
We've got a number of questions, so I'd like to pick up on those. Nilesh asks, so for a 1 million rand investment, the payment after performance fee would be?
I suspect that'll be, I mean, I don't have the number offhand, but I suspect it would be somewhere in the 1.16 million rand, somewhere around there.
Skulk asks, are those returns stated for the 5 years or per annum?
So these are all per annum returns. It's over the 5-year period, but it's a per annum return. So it's not cumulatively 15%, it's 15% per annum.
Yapi's question.
So sorry,
Jonty?
if I can just elaborate on that. So just to break the 15% down, so there's a tax benefit depending on your marginal tax rate. There's a dividend, performance dependent, but if you look at past years, Gaurav mentioned for the last 30 months, every 6 months we paid a dividend. There's a gross dividend of 5%, net dividend of 4%, and then there's capital growth. So between 2 and 4% we're experiencing per year. So when you combine those, it comes to, if you're in the highest bracket, 15% per year.
Yapi asks, what is the penalty for early settlement of these loans?
There's no penalty. Investors can take a loan for a month or for 4.5 years. So there's no early penalty settlement. And we have a few investors who have just sold a property. They know what their capital gains tax event is, but the proceeds from the sale will only occur, they'll only receive it in September. So they've taken you know, about a 4-month loan. So it's really up to the investor. There's no early penalties.
Nilesh wants to know, what is the interest rate from the 1st of October 2022? In other words, after the 4% runs out, and what are the repayment terms?
So
Go for it, Jonty.
Thanks. So from October 2022 for 5 months, it's fixed at 9%, and so that'll take you to February 2023, and then from there it's prime plus 2 for the rest of the term. In terms of installments or repayments, in October 2022, next year, 45% will have to be paid. So for some investors, that'll be their full refund. Some may have to top up to get to 45%. And then every October, it's 20%. So in 2023, 20%, 2024, 20%, and in 2025, it's just under 20%, and that includes the interest rate roll-up. So yeah, those are the payments that an investor will have to make over the funding term.
Leslie wants to ask, if you do not raise the expected amount of 375 million rand, what sectors and businesses would you prioritize?
Yeah, so Leslie, that's not the amount we need to raise, 375 million. 375 million is just the current pipeline, and that pipeline has some businesses which we have finished diligencing and we're ready to invest in, and others which we are still diligencing. Some of those may fall out. And so and sometimes other ones replace them. So we call it in the industry called a moving feast. But that being said, our prioritization follows a few things. So firstly, we prioritize by the risk and return. So we obviously look at businesses that have a good track record and are still providing good returns because of the underlying dynamics of that industry. And secondly, we prioritize based on diversification. So if we already have a bit of exposure to, let's say, solar PV, then we don't necessarily want to increase the exposure there because we then have too much exposure in that industry. So we then try and diversify across industry. That's our second criteria. And then finally, we then finally prioritize by what will be ready for investment as soon as possible. And that goes back to the point that we don't want our investor money sitting just earning interest and harming returns for our investors. So we take that into account when we look at, if there's an investment that's producing higher returns, but we can only make that in 2 years' time, then we might actually prioritize something that's earning a little bit lower returns, but we can make right now. And overall, the investor's better off.
There's a question from Lawrence. Maybe if you could just repeat the interest rate after October 2020. Sorry, 2022.
It goes to fixed 9%. So from October till February 2023, it's 9% fixed. And then it goes to prime plus 2. Currently prime, I think, is 7.
And Brian wants to know what happens if our chosen investment falls over.
So
falls out.
So Brian, what happens is that you invest into the fund and then you get diversified exposure. The fund manager, we choose how to make those investments. And if one of them do fall over, well, there's a couple of things that happen. The first thing is that we contractually build in to all of our investments a step-in right. And what the step-in right is that if that first loss that has been co-invested with us, if that's eaten into partially, and we set a certain milestone, if it's eaten into partially, we are allowed to appoint a controlling number of directors in the investment and take over the investment. And then what we do is we then take a decision, but what we may do at that point is say, well, we want to now try and mitigate the damage. And so we go in, we might try and recover the assets that are, let's say, not paying, and we then try and sell that on or redeploy. So if in this process we take some losses, there's still some first loss left. And so our intention is to protect our investors and only make the losses suffered by our co-investor. So that's the kind of our first set of recourses. We actually try and take over the investment and manage it, and if necessary, then liquidate it while there's still some first loss buffer left over.
We're getting very close to the end now, so I guess let's try and get through the last of the presentation, which here it is.
Yeah, so we can just take questions, yeah.
And that's it, yeah. So well timed, Gaurav. And Jonty, just maybe to sum up, because we literally just have a couple of minutes left before our hour has run out. Why would this, or what kind of person would want or would benefit from investing in the Jaltech fund?
So, Gaurav, if you wouldn't mind me starting, and then you can jump in. But so obviously, firstly, this is a tax-driven incentive, right? So if you don't have a tax problem, whether it be capital gains tax or income tax, don't even consider a Section 12J investment. If you do, the type of person who's investing into our fund is someone who wants moderate returns or stable returns. We're not promising investors 30, 40, or 50% annual returns, because that's not the nature of the underlying investments that we make. So our typical investors are someone who they're very comfortable with a 5% or net 4% dividend per year with some capital growth and a tax benefit. So we're more focused at moderate risk, more conservative investors, as opposed to your more high risk investors.
Yeah,
and
I think that
the exit strategy, the 5-year. So let's just say you've got let's go for the highest tax rate. So you've got nearly 1.5 million in taxable income this year. You can, through your gearing up facility, put in 100,000 and then end up with what would you could get 2 million rand in assessed loss with 100,000. You could write that all off against your taxable income of 1.5 million this year, and then carry forward another 500,000, and effectively you're going to be paid back. If you're a PAYE taxpayer, you're going to be paid back all of the tax that you've paid this year because you're writing it back. Is that the way it works?
Spot on.
That's exactly right.
And then for the next 5 years, you will receive a dividend equivalent to what you put in.
Performance dependent, but if we take the last 3 years as an example, that should be the case.
And when you gear up in that way, you'll be liable for paying back the loan over 5 years.
4.5 years, of which almost half of your loan, if you're in the highest bracket, will be repaid through the refund that you receive.
And what is your exit strategy once you invest in a company?
Well, most of these businesses, because they have assets in their balance sheet and they've got contractual cash flows, which they've now proved for 5 years, they are quite easily able to access debt funding at that point. It isn't debt for growth, it's debt to refinance based on assets and historical cash flows at that point. So those businesses should be able to access debt to buy us out. But secondly, if they can't do that, there is quite a deep and liquid market for asset rental books, etc. And so the banks, the big four banks, and then the other banks like Sasfin and financial institutions like Merchant West, for example, they all focus on this. And so there's the opportunity to sell the underlying assets along with their rental contracts in order to buy us out, buy out our shareholding. So we've got a few different investment strategies, but there's a final risk mitigant, which is that from year 4 onwards in the investment, we have the ability to prevent the underlying business from reinvesting the money it's receiving every month, the contractual cash flows. And this can then allow it to build up the capital buffer it needs over a period of, let's say, 1.5 to 2 years to then buy out Infinity, and then Infinity uses those proceeds to then buy out the investors.
And sorry, just to add, Alec, is as I mentioned earlier, as a fund manager, we incentivize around a performance fee only on exit. So we only receive our performance fee once we exit our investors. So we're very much incentivized to pre-negotiate an exit with an investee company or invest into businesses which we think are very liquid at the end of the term. So, we're very much aligned from an investor's perspective.
Jonty, Gaurav, thank you for presenting the opportunity to the BizNews community today. We look forward to seeing how everything ends up, but it's an exciting prospect. And as you put it out so well, it's also that you've gone for the low risk. And I like that. I made a point of this recently, that when I started a company in the early days of the internet, I realized that the growth of the internet was going to be such that you didn't really need to shoot the lights out. All you needed to do was just be around. And it seems a similar situation here, in that the growth of 12J starts off with that 8% a year that you get in tax benefits, unfortunately ending on the 30th of June. So we don't really have that much time, but at least while it's there, use it for what you can. Until the next time, I'm Alec Hogg. Look forward to being in your company. Till then, cheerio.